Welcome back. Today, we're doing a deep dive into, well, a complete contradiction in the financial world.
It really is.
Our sources are painting this picture where stocks are just soaring, right? The market is risk on. But at the same time, all the economic data we're seeing is getting worse.
Yeah, it's flashing these pretty serious warning signs.
So we are deep in this bad news is good news narrative, and we really need to unpack what's driving that conviction.
It's an environment that's just, it's defined by extremes. And all the enthusiasm you're seeing, the Dow, the NASDAQ, the S&P 500, all up, it's all coming from one place.
The Fed?
Anticipating Fed action, exactly. But that's masking some really fundamental pressures. So to help you get your head around this, we're going to zero in on three areas.
Okay.
First, the almost certain expectation for a Fed rate cut in December and why everyone thinks it's a guarantee. Second, some surprisingly strong corporate stories.
Right, despite the bad macro news.
Exactly. And finally, the friction we're seeing on a global scale, trade issues, different central banks doing different things. It's a complex picture.
And that psychology is just perfectly captured by the recent market action. I mean, the NASDAQ was leading the charge up over 0.5%. And this is all happening as bond markets stabilize. The 10-year yield is around 4.1%. Even Bitcoin has calmed down, settling near 91,000.
It's just the sheer force of belief in that rate cut. It's the dominant narrative, period.
The gravitational center of the whole market.
That's a good way to put it.
So let's start there. The December 10th Federal Reserve meeting, everyone's focused on it. The CME FedWatch tool is pricing in, what, an 87 to 88% chance of a cut?
That's right. A 25 basis point cut, that would take the federal funds rate down to the 3.5% to 3.75% range.
And the logic here, it seems almost too simple.
It is, but it's powerful. The market is basically treating weak economic data as a binding contract. A guarantee that the Fed has to step in and ease policy.
So if the data is bad, the Fed has no choice.
No, that's the bet. And if you just look at the manufacturing sector, I mean, the proof is right there.
The ISM number.
The ISM manufacturing PMI fell to 48.2 in November. Now remember, 50 is the line. Anything below that is contraction.
So 48.2 is not just weak, it's
the 9th consecutive month of contraction. And what's really important is that the forward-looking parts, like new orders and production, are what's dragging that number down.
And historically, manufacturing weakness is a big red flag.
A huge one. It's often a precursor to wider economic problems, and the market is just banking on the Fed seeing this and saying, okay, this is too much to ignore.
And we're seeing the labor market starting to cool off, too, which is what the rate cut advocates want to see.
Exactly. Job gains are slowing. The unemployment rate has ticked up a little bit to 4.3%.
So if this cut happens, it's the third one in 2025? That's a very clear direction.
It absolutely does. And it's not just the rate cuts. You have to remember this is happening alongside another huge structural easing move.
You're talking about quantitative tightening.
The end of it, yes. The Fed is stopping the runoff of its balance sheet starting December 1st.
Okay, hold on. Let's break that down. So if a rate cut is hitting the gas pedal, is ending QT like taking your foot off the brake? Is that the right analogy here?
That is the perfect way to phrase it, yes. QT, or quantitative tightening, is the Fed letting bonds mature off its balance sheet. It's basically draining cash from the system. It's the brake.
Okay.
So when they end the runoff, they stop that automatic draining process. They're no longer actively shrinking the money supply.
So you've got both at once, hitting the gas and taking the foot off the brake.
Which signals a major pivot. I mean, you're talking about injecting hundreds of billions in liquidity back into the system over time.
That does sound like a done deal, which explains why everyone's so convinced. But when you read the actual Fed minutes, they don't sound nearly as unified.
Not at all. There is a lot of internal tension.
The sources say they have strongly differing views.
They do. They're really caught between a rock and a hard place. They've got the cooling labor market on one side.
But inflation is still too high on the other.
Exactly. And that's where I would challenge the market's premise. I mean, the Fed's primary mandate is price stability. Core inflation is still running around 2.9%, almost a full point over their 2% target.
Right. So isn't the market making this massive bet that the Fed is just going to prioritize jobs over inflation?
It's a profound risk. You've hit on the core conflict right there.
It just seems incredibly risky to bet the farm on some weak manufacturing data when you're still missing your inflation target by that much.
The bet is essentially that the cost of preventing a recession is higher than the cost of tolerating slightly sticky inflation for a little while longer.
So they're predicting the Fed will decide that getting from 2.9% to, say, 2.5% is less urgent than stopping job losses.
That's the calculus. But you're right. If inflation proves more stubborn, that market confidence could just evaporate instantly.
And all that macro uncertainty, it makes the strength we're seeing in some of these individual company stories even more incredible.
It really does.
So let's move to our second area, the corporate fundamentals that are driving some of these gains.
And the biggest headline here, and it's a massive one for a legacy industry, is Boeing.
Shares were just soaring. Up, what, over 10%?
Over 10%, yeah. And it's because their CFO, Jay Malav, came out and gave a very clear path to financial recovery. They're now projecting low single digits, billions in positive free cash flow in 2026.
And that's a reversal. Right, because they were expecting to burn cash this year.
A huge reversal. They're going from a $2 billion cash burn in 2025 to positive cash flow. It gives them a credible path to their long-term $10 billion target. It's just pure execution overcoming the noise.
A really strong industrial turnaround story.
Yes.
But, the biggest momentum is still in tech. It feels like the AI and cloud boom is just completely immune to that manufacturing slowdown we were just talking about.
It is remarkably resilient. I mean, look at MongoDB, the database software maker, ticker MDB.
It just exploded, up 22, 25%.
After their Q3 results just blew past estimates. I mean, earnings of $1.32 versus an 82-cent consensus. That's a huge beat. And Credo Technologies, CRDO, also surged.
So what does that signal to you?
It clearly signals that companies are not pulling back on their spending for AI-linked digital infrastructure, that CapEx is strong.
That's key, right? It's kind of the market's internal contradiction.
It is. The whole NASDAQ rally is partly this concentrated bet that software and AI spending will just keep growing, even if the old economy, the factories and stuff, is contracting.
A bet on the digital future.
Withstanding the real-world present.
And here is where it gets really fascinating. You contrast that tech strength with these really severe warnings we're hearing about the U.S. consumer. It highlights this sharp divide.
The signs of stress are undeniable, and they are landing squarely on the lower and middle income shopper.
We saw that with Signet Jewelers.
Exactly.
Yeah.
The parent company of Kay and Zales, their stock dropped quite a bit after they issued a weak holiday forecast. They cited a measured consumer environment.
Measured is a very polite word.
It is. And we also heard it from Procter & Gamble's CFO, who called the landscape volatile. They specifically said lower-income households are struggling, while the wealthier consumers are still trading up to premium products.
So we're right back to the Fed's impossible job. This consumer bifurcation, this split, it's what makes their decisions so hard.
How do you fix one without hurting the other?
Exactly. You can't cut rates to help the person shopping at Kay Jewelers without potentially driving up prices for the wealthier consumer, which just fuels more inflation.
They have to choose which economy they're trying to fix. And meanwhile, you have these other big corporate events moving whole sectors.
Let's get into the M&A activity first.
Okay, so a huge deal in the insurance space. The Baldwin Group, BWIN, announced they're merging with CAT Group. It's a deal worth just over $1 billion.
And that's a smart move for them financially.
Very smart. It's expected to add over 20% to their 2025 adjusted earnings per share. And it creates the largest colleague-owned, publicly traded insurance broker in the country. It just shows that consolidation is still a really powerful way to drive profits.
And the second story is a huge legal one.
A massive one. The Bayer and Roundup saga. Bayer's stock surged, up 10 to 13%, after the U.S. Solicitor General basically supported a Supreme Court review of the Roundup lawsuits.
Okay, and why is that so significant?
Because the Solicitor General specifically noted that the EPA has long held that glyphosate, that's the chemical in Roundup, is not likely to be carcinogenic.
So Bayer's trying to get a definitive ruling.
They want the Supreme Court to decide if a company that complies with federal standards can still be sued under state failure to warn laws.
This becomes about so much more than just a single product then. It's about setting a huge precedent for corporate liability in the U.S.
Exactly. Bayer is trying to establish that federal compliance should, preempt these state-level claims. If the Supreme Court agrees, it could invalidate thousands of lawsuits. It's a huge deal for manufacturers everywhere.
It's really a question of whether a company can ever rely on federal policy when state laws are still a threat.
That's it.
Okay, so now let's broaden the view. Let's talk about the global factors that sparked some of the market jitters earlier in the week. Where did that pressure come from?
It all comes back to this thing we're calling the Japan jolt, and it's a perfect example of how interconnected everything is.
Okay.
The sell-off we saw in U.S. Treasuries, the one that pushed our 10-year yield up, that was actually triggered by spiking Japanese government bond yields.
So something happening in Japan's bond market directly hit the U.S.
Directly. And that spike was driven by speculation that the Bank of Japan, the BOJ, is finally ready to hike rates. ING analysts are even predicting a hike in December.
And that's critical because it's a total decoupling of policy.
A major monetary policy decoupling. The U.S. Fed is easing, and the Bank of Japan is moving toward tightening.
And why does Japan tightening affect us so much?
Because Japanese investors are massive holders of U.S. debt. If rates are suddenly more attractive back home in Japan, their fund managers have an incentive to sell their U.S. bonds and bring that money home.
And that selling pressure is what causes our yields to spike.
Immediately. And that triggers volatility across the entire global financial system.
And this global friction, it's not just interest rates. It's also about trade and what that means for growth long term.
Absolutely. The OECD, for example, expects global GDP growth to slow down in 2026. And their analysis is, well, it's pretty sobering.
What did they say?
They specifically warn that the negative impact of tariffs and more trade barriers will likely outweigh the good stuff, like all the spending we're seeing on artificial intelligence.
Wow. So even the AI boom can't overcome trade friction.
That's their forecast. They're projecting U.S. GDP growth slowing to 1.7% in 2026 as a direct consequence of this.
And that tariff conflict is still very much alive, right? I mean, big companies are taking legal action.
Yes, the warehouse giant Costco is actually suing U.S. Customs and Border Protection and the previous administration.
What for?
They want a refund on tariffs they paid on imports. And it's all contingent on the Supreme Court finding the tariffs unconstitutional, which, by the way, lower courts have already done.
So it just highlights the real financial pain these policies are still causing.
Sustained pain. It's forcing companies like Costco to literally change their supply chains, shift where they import from, just to minimize the financial hit.
And tying it all back to the global economy.
The UN's Trade and Development Body, UNCTAD, warns that global growth is going to slow even further, down to 2.6% in 2025. And they blame that persistent financial volatility and geopolitical uncertainty.
They also pointed to another growing risk, one that's tied directly to us, the dominance of the U.S. dollar.
Correct. The dollar's share of cross-border payments has shot up to about 50%, which creates a really difficult situation for developing countries. Because even if their own economy is doing fine, they are incredibly exposed to U.S. financial cycles.
So just to simplify this, if the U.S. dollar is that dominant, are the world's developing nations basically forced to run their financial lives on the Federal Reserve's clock?
That is the perfect way to think about it. If the Fed sneezes, half the world catches a cold, because all this critical trade and debt is priced in a currency controlled by one entity, responding mostly to its own domestic economy.
So if we step back, the market is just riding this wave of optimism, this belief that the Fed will come in and save the day.
Mm-hmm.
But at the same time, it's facing these very real systemic risks, from global trade to what other central banks are doing.
That is the core tension. The bad news is good news idea is thriving because the market needs that bad data to force the Fed's hand. But that optimism is being challenged by reality. The U.S. easing while Japan tightens, and the continued drag from trade uncertainty.
Which really means, for you, the investor, you have to be selective.
Yeah.
You have to notice that individual corporate execution, like that amazing turnaround at Boeing or the AI sales at MongoDB, is strong enough right now to override some of that macro noise.
Exactly. But let's leave you with one final thought, tying that AI enthusiasm back to the potential for systemic risk.
Okay.
S&P Global recently assessed credit conditions here as favorable yet fragile, and they highlighted one very specific concentrated risk: the potential for a sudden, rapid slowdown in AI-related spending.
Yeah.
Because so much capital has flooded into this single theme, the very theme that drove this whole NASDAQ recovery, that AI investment itself has become a new source of systemic financial risk.
So given that AI stocks led this entire recovery,
You have to ask yourself, are we building our current market stability on a single high-risk foundation that could be incredibly vulnerable to a sudden correction?
a fascinating and really critical question to think about. Thank you for taking the deep dive with us today.